Right now, there's a company worth almost $2 trillion. It just pulled off the biggest stock market debut in human history. Bigger than any IPO ever recorded, 3 times bigger than the previous record holder. And here's the strange part. It loses money, almost $5 billion of it last year alone. Everyone assumes the winners of an IPO like this are the people who got in early, the insiders, the believers, the ones who bought the dream before anyone else could. But that's not quite how this one worked out, because the biggest winner already cashed out, and the person left holding the bag might be you. Not because you bought the stock, you probably didn't, but because of a quiet little rule change nobody told you about, there's a very good chance you own a piece of SpaceX right now, whether you wanted to or not. And to understand how that happened, you first need to understand what SpaceX actually is, because it's not the company most people think it is. Ask 10 people on the street what SpaceX sells, and most of them will say rockets. A few will say Mars. Both answers are wrong. SpaceX isn't one company. It's 3 completely different businesses wearing the same jacket, and the rocket part isn't even the important one. Let's start with the ugly one. It's called xAI. That's Elon's artificial intelligence lab, the one that also owns the social media platform you probably still call Twitter. Earlier this year, in a move that raised more than a few eyebrows, one of Elon's companies bought another one of Elon's companies. SpaceX absorbed xAI in an all-stock deal, and xAI got valued at $250 billion. Now here's the thing about that valuation. xAI brings in roughly $1 billion a year. For comparison, its rivals bring in 20 to 30 times that and are valued at less. So the market decided to price a business burning through more than $1 billion a month as if it were one of the crown jewels of the tech world. It isn't. Think of xAI as the reverse money printer. Whatever cash the rest of the company makes, this part quietly sets on fire. And it gets stranger. When xAI was founded, it launched with 11 co-founders. Serious people poached from the best AI labs and universities in the world. A genuine dream team. By the time SpaceX absorbed it, every single one of those 11 had walked out the door. Elon himself admitted in public that the whole thing basically needed to be rebuilt from the ground up, which is a remarkable thing to say about something you just valued at $250 billion. So when we call this the ugly part of the business, we're being generous. Then there's the rocket business. This is the part everyone pictures. Launches, satellites, missions for NASA, cargo to the space station. It's genuinely impressive engineering, and last year it brought in around $4 billion, which sounds like a lot until you remember we're talking about a company valued at nearly $2 trillion. The rockets are cool, they're just not what's paying the bills. Which brings us to the crown jewel, the business almost nobody thinks about when they hear the name SpaceX. It's called Starlink, and it's basically internet from space. Thousands of little satellites beaming broadband down to a dish on your roof, reaching places cables never could. Planes use it, ships use it, remote villages use it. It launched properly only a few years ago, and it's already the fastest growing telecom company that has ever existed. Starlink pulled in over $11 billion last year. That's around 60% of everything SpaceX makes, and its profit margins aren't just healthy, they're accelerating, jumping from roughly 40% to over 60% in the space of 2 years. So this is the real picture. One business that prints cash, one that's respectable but wildly overvalued, and one that incinerates money by the month. Put them together, and you get a company that made around $18 billion in revenue last year and still managed to lose nearly $5 billion. So let's ask the obvious question. Who on earth decides to buy a money-losing company at the most expensive valuation in stock market history? And the answer, as strange as it sounds, is you. To understand what happened, you need to know about something called the Nasdaq 100. It's an index. Think of it as a VIP list of the 100 biggest non-financial companies on the Nasdaq exchange. Getting on that list is a big deal, and not just for bragging rights, because there are hundreds of investment funds holding well over $800 billion whose entire job is to mirror that index. Here's the key part. When a company joins the list, every single one of those funds is forced to buy it. They don't get a vote. They don't get to decide whether it's a good price. If the index says buy, they buy automatically, instantly, in the billions. Now, under the old rules, a newly public company had to wait at least 3 months before it could join. That waiting period existed for a reason. It gave the market time to figure out what the stock was actually worth before all that automatic money came flooding in. 3 months of the market doing its homework. But in May of this year, quietly, with almost no fanfare, the Nasdaq changed that rule. They introduced what they called a fast entry rule, and it cut the waiting period from 3 months down to just 15 trading days. 3 months of price discovery compressed into 3 weeks. Now, timing is everything here, because SpaceX went public in June. The rule that made its fast entry possible was written weeks earlier. You can decide for yourself how much of a coincidence that is. And it wasn't the only rule that changed. There used to be a requirement that a company make at least 10% of its shares available to the public before it could join. SpaceX only floated around 4 to 5%. Under the old rules, it wouldn't have qualified. Under the new ones, that requirement had quietly disappeared. The red carpet wasn't just rolled out, it was custom fitted. And there was one more twist buried in the fine print. The strangest of the lot. For companies with a really small float like SpaceX, the new rules let the index treat that float as 3 times bigger than it actually is. So a 5% slice gets counted as if it were 15, which means the funds are forced to buy even more of it than the real, tradable supply would normally allow. Listen to that again, because it's worth it. The rules were rewritten so that funds must buy a larger position in a company than the market is actually offering for sale. So SpaceX goes public on the 12th of June, and at first it looks like a triumph. The company sets its price at $135 a share. It opens at $150, and then it takes off. Within 4 days, the stock hits $225. That's a 67% gain in less than a week. Headlines everywhere. Biggest IPO ever. Retail investors piling in, thrilled to finally own a slice of Elon's rocket empire. And on paper, everyone's a genius. The early buyers are up. The believers feel vindicated. The whole thing looks like a party that's just getting started. But here's what almost nobody watching the fireworks understood. The reason the price was climbing so fast wasn't because the company suddenly got more valuable. It was because there was almost nothing to buy. Remember that tiny float? When only 4% of a company is actually for sale and everyone rushes in at once, the price rockets. Not because of value, because of scarcity. It's the difference between a thing being worth a lot and a thing being rare. And a lot of people watching that number climb mistook one for the other. Then came the 7th of July. Exactly 15 trading days after the IPO, right on cue, SpaceX officially joined the Nasdaq 100. And this is the moment the machine switched on. Every fund tracking that index was now legally required to buy SpaceX. Not because a portfolio manager loved the company, not because anyone ran the numbers and decided it was a bargain, purely because the rules said so. And the numbers here are genuinely staggering. Analysts estimate that somewhere between $22 and $27 billion of automatic buying flooded in across all the funds tied to these indexes. One single fund alone generated over $4 billion of demand on its own. And here's where it gets personal. That fund is one of the most commonly held investments inside ordinary retirement accounts. So if you have a pension, a retirement fund, or any kind of savings parked in a broad market tracker, there's a very real chance that on that day in July, your money quietly bought a piece of SpaceX. You didn't click anything. You didn't approve it. You may not have even known it was happening. The mechanics of passive investing just did it for you. There's a phrase that gets used for this, and it's a little uncomfortable. People call it exit liquidity. It means being the buyer who shows up right when the early investors want to sell. And the timing of all this manufactured demand, arriving in one enormous wave, is worth sitting with for a moment. Because here's what happened next. The party ended. That $225 peak, gone. Over the following weeks, the stock slid and slid and slid. And just a couple of days ago, it did something it had never done before. It fell below its own IPO price. Below the $135 it started at, anyone who bought near the top is now down by roughly a third. Part of that was a stumble with a rocket launch that didn't go to plan. But the deeper reason is simpler. That scarcity that pushed the price up, it works in both directions. And a lot more shares are about to hit the market. Remember, insiders are normally locked out of selling for 6 months after an IPO. But SpaceX set things up differently. Starting in late July, waves of previously locked shares become available to sell. And the first wave alone is enormous, roughly 900 million shares. To put that in perspective, that's more stock than has been trading publicly this entire time. So the same early investors who got in cheap can now start selling into all that automatic demand. The forced buying that lands in your retirement account becomes the exit ramp for the people who were there first. And it isn't one clean release. The shares come unlocked in waves, spread across the following months, tranche after tranche, all the way through to the end of the year. There's even a clause that lets insiders sell an extra chunk early if the stock climbs high enough. In other words, the system is designed so that as the price rises, more sellers are quietly let out of the gate. The one person staying put, at least until well into next year, is Elon himself. His enormous stake stays locked, which means the biggest wave of all is still somewhere out on the horizon. Now here's the detail that ties the whole thing together, and it's the part I find most telling. There's another famous index even bigger and more respected than the Nasdaq 100, and SpaceX asked to be fast-tracked into that one too. They said no, flatly. That index kept its rule that a company has to actually be profitable before it can join, and SpaceX isn't, so it got turned away away, and it can't qualify for at least another year, and only if it turns its finances around first. Sit with that for a second. One gatekeeper looked at a company losing $5 billion a year and bent its rules to wave it through. Another looked at the exact same company and said, not until you make money. Same business, same numbers, two completely different answers. That contrast tells you almost everything you need to know about how this happened. So let's go back to the question we started with. The biggest IPO in history is over. Who actually won? The company raised somewhere around $75 billion at the highest valuation it will possibly ever command, right at the peak of the excitement. The earliest insiders are sitting on shares they bought for a fraction of the price, and the doors for them to sell are just beginning to open. Those two groups did just fine. The people who bought the pop, chasing that climb to $225, many of them are underwater right now. And the quiet majority, the people with a retirement fund who never bought a single share on purpose, ended up owning it anyway, right as more supply is heading their way. Meanwhile, the one group that got to sit this whole thing out were the people whose savings track that other stricter index, the one that said no. And this is the part worth actually thinking about because it's bigger than one company. Passive investing was sold to all of us as the smart, sensible, boring way to build wealth. Low fees, set it and forget it. Let the market do the work. And honestly, most of that is true. It's a genuinely good idea for a lot of people. But there's a piece of the pitch nobody really talks about. The very thing that makes it so easy, the fact that it automatically buys the whole index for you, is also the thing that makes you a guaranteed, unquestioning buyer of whatever manages to get added to that index. The convenience and the vulnerability are the same feature. You can't have one without the other. For years that was fine because getting into an index was hard. You had to earn it. But when the gate can be widened for the right company at the right moment, that automatic money stops being a reward for the best businesses and starts being a prize for whoever can get themselves added. Somebody just proved that's possible, and they won't be the last, because there are one or two other giant unprofitable companies watching all of this very closely, taking notes and getting ready to walk through the exact same door. None of this is a reason to panic about your savings, and it's certainly not us telling you what to do with your money. It's just worth understanding what's actually happening underneath the surface of something that looks completely automatic. Because the more you understand how these systems really work, the harder you are to surprise. And if you'd like more of the financial world explained the way it actually operates, rather than the way the headlines tell it, you know what to do. Stick around. We're just getting curious.